in September 2021 when we brought you an analysis of REITs or real estate investment trusts, a stock market listed investment option on the property show. Since then, the unit prices of three listed REITs, Embassy, Mindspace and Brookfield, have not only gone up between 15 to 20%, but all three have also paid out dividends. These REITs hold some of India's marquee Grade A office buildings occupied by top multinationals and Fortune 500 companies. Their stock market performance is linked closely to what the outlook is on leasing demand and rental growth of India's commercial real estate. So here we are with an Office Outlook 2022 to help you make up your mind whether some of your investments can be parked in REITs, especially at a time when the stock markets have started to look jittery and one sees only 20 to 25% headcount back in the swanky high-rise office campuses. Joining me on the show, Juggy Marwaha, CEO Prestige Office Ventures, Amit Diwan, Senior Managing Director and Country Head at Hines, and Gagan Randev, Executive Director, India Sotheby's International Realty. Amit, well, I'm going to come to you first because Hines has just announced its plans to raise an India-dedicated fund of $500 million to invest in office properties. So it seems you're fairly bullish on this segment, isn't it?
That's absolutely right, Manisha. Thank you for having us here. The market for office is clearly on the upswing on the back of strong job creation. And the second trend that we are super excited about is the flight to quality. Each of the REITs are showing strong performance because the occupiers want only very high quality landlords. And I think we have a space where we can participate there. You said Grade A assets, flight to that. And I think, Juggy, if I'm not mistaken, there are only 8 to 10 of those developers who actually have the capabilities to build such office campuses. Prestige Group is one. And I think you also have plans to build more than 40 million square feet of office space across multiple cities. But are we calling out normalcy returning to office assets or office segment too soon, just because fourth quarter seemed to be a little bit stable? Most IT/ITES companies are still in a hybrid work mode, and none of the parks are seeing more than 20 to 25% workforce returning physically to work.
Thank you, Manisha, for having me here. Yes, we are on a very aggressive rollout after the disposition we had with Blackstone, and we're moving forward with rolling out about 40 million square feet of space across the country. Flight to quality consolidation of the real estate space is a new norm today in the office markets. If you look at the way the REITs have performed also, like you were mentioning, about 80, 90 million square feet of office space, Grade A office space is controlled by the three REITs. From a perspective of where we are post-pandemic, I think green shoots clearly visible. Leasing volumes in the last quarter of 2021 went up almost 16%, and that was only because of three cities which really bumped up the leasing activity. Pune, Hyderabad and Bangalore contributed about almost 12 million square feet in the last quarter itself. With this pandemic, becoming an endemic, I think it's a matter of time when clients, large global occupiers, are asking their employee workforce to come back to work. Your point is absolutely right that 8 to 10% occupancy in large business parks is the norm these days. However, none of our large clients have given up spaces in the last 2 years, and people are holding up the spaces only because, like Amit mentioned, technology clients are doing very well, and more importantly, the hiring continues at a very robust level.
Gagan, would you agree with this euphoria? Because I'm looking at the numbers again. I actually said that headcounts are back 20 to 25%. Juggy is actually saying that there are only 10 to 15% headcount which has come back to office parks. And if I look at the occupancy levels, they're down 2% vis-a-vis 2020, which was a terrible year, right? And I don't have the 2019 number, but it could be higher, much higher number. So why this euphoria? There has to be more to this story.
No, so one, I think if we were to cut away the last 24 months, which is the COVID era, we were on an average, the demand over the last 4 years was in excess of about 40 million square feet per year. And we're talking of the top 7 cities. Now, last year, despite everything, we will finish the year with about 39 million square feet of leasing, of which about 12.8 million square feet came in the last quarter, which was actually the strongest quarter in the last 8 quarters. So we are clearly seeing a bounce back, which is happening. The second thing which gives us a lot of optimism was that we were in a perpetual period of paranoia, fear about COVID, the wave 1, the terror we went through in the wave 2. And ultimately, I think the wave 3s seem to be, if I can use the word, almost like a damn squib, because you never saw anywhere close to the kind of, I would say, the pandemonium we went through in the phase 2. So I think what's happened is there is a lot more confidence with occupiers coming back. And I think that 10-15%, which is the norm today, is not going to take time to move up to 25 to 30% as we are seeing, because there have been recent announcements by large ITS companies and the biggest occupiers in the country to have at least 25 to 30% of their workforces back in offices by March. So we are definitely going to see that shift happening, coming back.
Okay, let's look at city specific now. I mean, I think the NASSCOM report, which has come out just yesterday, corroborates what you're saying, that look, the digital explosion which has happened globally means that a lot more of ITS work will move to India. Amit, cities now. So, Juggy mentioned 3, Bengaluru, Pune and Hyderabad. Where would you park your money? What are, according to you, markets which are likely to outperform when it comes to leasing demand?
Bangalore and Pune for me. I think the role of the IT sector in the office absorption is very clear and well understood. I think when you layer upon that the demand and supply situation, Hyderabad feels a little bit risky to me in comparison to Bangalore and Pune.
Oversupply? Because of the oversupply that you see?
I think there will be. I think there is pain to come in the office market. It's not all rosy, going back to your previous question as well. I think there is strong job creation. There is also de-densification, but there is a reality called hybrid working, and I think it's here to stay. What all of the large landlords and developers in India are chasing is the flight to quality, the ability to create alpha. If we are all banking on beta, I think there is a risk. And that's why REITs with institutional ownership make sense. And large and well-capitalized, high-quality developers coming into the market are chasing alpha opportunities, not really beta. And I think from a beta perspective, Hyderabad looks slightly weaker to me than Bangalore and Pune.
Okay. Juggy, you've already given us the pick of your cities. But let me just also ask you another very interesting question, because, this is a general news channel, so we need to just get down to the very basics. In an Economist article which came out this week posed very critical questions around the changing nature of work, which Amit also alluded to, hybrid work model, which is here to stay. They talked about emptying out of buildings in Manhattan and London. Why do investors and developers like you think of India differently? Why are we thinking that 2022 to 2024, we're actually going to see a return of the office in a big way?
So quite clearly, I think people realize one thing, Manisha, is that physical workplace can't be replaced. So that's period. So yes, there will be a choice between companies choosing the hybrid model and flexi spaces. So quite clearly, I think that hybrid is here to stay. So flex is the future, and that's why you see a huge, attraction towards the co-working space, which used to be about 3 to 4% of annual leasing in India, has gone up to almost 8-10% of the total gross leasing volume. So that's one. Second, I think major technology companies are growing. I was talking to one of the largest occupiers of our spaces in our portfolio in Prestige, and they were saying they've hired almost about 150,000 engineers in the last 18 months, and none of them have seen the physical space of office. So they want them employees to come back, because culture, all, the soft aspects of being together, collaboration, this can't be possible over WebExes. And people realize that, yes, they would give the flexibility to their employees to work, because that's all about knowledge capital. It's about the equity of what mind share they have in their spaces. But collaboration and getting people back in offices is the only way forward, and companies realize that. Even the large companies who actually shied away from bringing their employees back during the first and the second wave have almost now for certain announced that by first week of March and first week of April, between that period, most of their employees are going to come back to work. And you just heard about Microsoft calling back all their global employees on first week of March. So I think it's a matter of time, and even during this period, I think you raised the question of investors, very important point. Right through the pandemic in the last 2 years, our office rents and collections have always been in the 90s, late 90s. It shows that companies who want these spaces are not going to give up these spaces because they are sitting on long old leases. And for them to give up these spaces, they won't get back the same space in the same commercial terms in a hurry.
So that's the crux of the thing, right? That even though offices have got emptied out, Juggy, rental collections have been 98 to 99% for at least the listed REITs where we have the numbers, and you're saying late 90s for your company as well. What about the rentals themselves, Gagan? Can you shed some light on whether, developers have been able to strike new deals at a higher rental even in these tough times? Because that then gives us another indicator of how things are likely to go forward.
So before Manisha, I come to rentals, I think it's important to give a perspective of the rentals in India compared to the rest of the world to show how much of an arbitrage we still have. If you look at an average of rentals in India, the rental per square foot is about $1.20 across. It varies from 70-80 cents in Hyderabad to about $1.10, $20 in NCR and Bangalore, going up to $1.60-80 in Mumbai. Now you compare that to a Shanghai and Beijing, $5 per square foot, to a Singapore, $7 per square foot, a Hong Kong, $10, a London, $11. It just tells you how much of an arbitrage we have in terms of rentals. Now, if you look at the last 2 years, were the years worst hit because of COVID. And despite that, if you look at our grade A developments, the rentals in the grade A developments have been strong and in a lot of cases have actually moved up. So if you were to look at the better developments in ORR, Bangalore, in BKC, Mumbai, around the Cyber City and the new developments like Downtown, One Horizon, etc., the rentals have actually moved up. But if you were to look at grade B developments, I think there has been a definite drop or I would say stagnation of rentals in those micro markets. So grade A has performed very well and continues to outperform in these times.
We have very restricted time. I think I'm going to quickly get your views on REITs. What, Amit, according to you, is what happens to REITs when interest rate cycles start turning around? Is that a headwind and a threat to how REITs are likely to perform going forward? Or do you think that there is a direct and a positive correlation between interest rates rising and REITs?
Yeah, so I think in general, the direction of movement will be similar between interest rates and the REIT cap rates. However, the degree of change is going to be very different. So as an example, when the interest rates have fallen in the last couple of years by almost 2%, the REIT cap rates have compressed only 50 basis points. And when the cycle reverses, I think the impact will not be as high. So let's say for a second, even if the cap rates go up by 50 basis points, you're really investing in a REIT product for total returns, not just the yield. The yield is an important component, but there's also the capital value appreciation that comes with it. So I think it remains to be a relevant and an interesting product. And somebody looking at expanding into a REIT portfolio should, in my view, start accumulating and maybe like a SIP equivalent, keep buying the REIT stock. I think it will do well.
I think I'm going to conclude there. Thank you, gentlemen, for joining me. I've started to get a sense of why there continues to be such an excitement amongst institutional investors for office assets. Fundamentals seem to be running strong. Thanks again for being part of this discussion.
Thank you.
When we return, we decode the latest ruling by the Supreme Court in favor of home buyers over banks and housing finance companies in case a project and developer goes into liquidation. This is an important judgment for home buyers. Stay with us to find out why.